Welcome to the online classroom for the module FIN2601. In this class, I'm going to be taking you through part one of the exam preparation. So once you've covered all the classes from the first learning units to the last one, the next important thing you have to do with regards to your preparation is to do some exam prep classes, right? So I'm going to be taking you through a number of questions in the classes that are going to follow. And in this class, I'll be focusing on ratio analysis. So you've been given, we've been given some questions, some exam practice questions or mock exam questions for 2022 semester one. And then I'm just going to be going through those as part of your exam preparation once you're finished going through all the material, just explaining some of the important concepts you need to know for the exam and how to do certain calculations, okay? And then something important to note is that I just got these questions, right? So you might find that the person I got these questions from had answered by picking certain options. Those options that were picked are not necessarily the right ones, right? I'll be calculating the correct ones and showing you what the right options are. So please don't, if you see any options picked here, it doesn't mean that's the correct answer. The correct answers are going to be the ones that I'm explaining as I take you through the class. So I hope you'll be able to follow that. So in this first class, I'm going to be focusing on ratio analysis, right? I'm just going to be looking at questions to do with learning units showing the module where you have to calculate or do certain calculations involving ratio analysis. So in the exam, you're going to have a number of questions, right? You're going to have questions on theory, and the theory part is the part that's usually covered in learning unit one. And then you're going to have questions on financial statement analysis or ratio analysis, right? And this is covered in learning units 2. And then there's time value of money, which I think is covered in learning unit 3, right? And then, in learning unit 3. And then we also have, sorry about that, covered in learning unit 3. Then we also have risk and return. Risk and return is covered in learning unit 4. And then I think we have bond valuation, which is covered in learning unit 5. And then lastly, we have share valuation. So I think these are the learning units in this module. So in this class, I'm going to be taking you through the learning units on ratio analysis. And then in the classes after this, I'll also look at some time value of money questions, maybe combine that with bond valuation, and then maybe combine risk and return with share valuation and maybe some theory. So this lesson, this exam prep class is going to be focusing on ratio analysis, how to approach questions on ratio analysis, how best to answer them, and the best approach you can use for the exam with regards to those particular questions. Okay. So the exam prep for 2022 semester 1 that I'm going to be basing the classes on, it actually goes up all the way. I think you were actually given like up to 70 questions, right? So in this particular class that I'm going to be conducting, I'm just going to be taking you through the ratio analysis questions and explaining some important concepts. And I think that covers the first 16 questions. Okay, so we can get started, starting with number 1. So question number 1 says, Jane and Jane Limited reports the following data for the past year. We're given the profit for the past year. We're given the earnings per share, we're given the total equity, and we're given the market to book ratio. And then we're asked to calculate the market price per share. Now, when you're dealing with the ratios for FIN2601, the starting point should always be to write down the formula of the ratio, right? That you're asked to find. And then if you're not asked to find any particular ratio, but you're just asked to find the market price per share, you need to ask yourself, have I been given any ratios here which contain the market price per share? And we know that the ratio, here we've been given two ratios. We've been given earnings per share and market to book ratio. And the ratio which contains market price per share is the market to book ratio. So it means this ratio is going to be the ratio that helps us to determine the price of a share. So we know that the market to book ratio is given by the market price per share divided by the book value per share, right? So there's actually a nice formula we can use to help us to calculate the price, the market price of the share if we've been given the market to book ratio. And the formula simply says that we can take the market price per share, and then we can multiply it. We can take the market to book ratio that we've been given. This is the formula for the market to book ratio. If we want to get the market price per share, we can simply take the market to book ratio, and we can multiply it by the book value per share. And then the answer we'll get here will give us the market price per share, okay? So the calculation is here. So the calculation we would do here is simply take the market to book ratio and then multiply it with the book value per share, right? And the idea behind this is that if you've been given things like the market to book ratio, right? The market price to book ratio, and you want to get the price of the share, you can simply take your market to book ratio, multiply it by the book value per share, and then that will give you the price. The same follows if you've been given, let's say you've been given, for example, the earnings per share, right? And you want to get the price per share. You can simply take, sorry, if you've been given the price to earnings ratio, if you've been given the price to earnings ratio, you can simply take your price to earnings ratio and you can multiply it by the earnings per share, and it will give you the price of the share. So these are just two important formulas to remember to help you to calculate the price per share, right? We can simply take our market to book value, multiplied by the book value per share, and then that can give us the price per share. Or we can take the price to earnings ratio, multiply that by our earnings per share, and that will give us the price. Okay, so these are two important formulas that involve these types of ratios that you can use to help you to determine the market price per share. So for us, we've got a problem. Even though we've been given the market to book ratio, we haven't been given the book value per share. So we have to calculate the book value per share. And then we can take the market to book ratio and we can multiply it by our book value per share. And then that will give us the price per share, right? And then to get our book value per share, we can get our book value per share by simply taking the total equity divided by the number of shares. And then we haven't been given the number of shares. We've been given the total equity, but we don't have the number of shares. And then we can calculate our number of shares simply by taking our profit for the year divided by the profits per share or earnings per share. So we can divide these two. We can get the number of shares by taking the total profit for the year divided by the profit per share. Okay, so this will give us the number of shares. And then we can get the book value per share by taking our total equity, right, minus preference share capital, but we don't have preference share capital here, so we don't have to worry about that. We just want the number of ordinary shares, right? And then we can divide that by, sorry, we just want the book value per share for the ordinary shares, right? So we take our total equity minus preference share capital divided by the number of shares. And then if we do that calculation, we can get the number of shares, which is given as 100,000. Then, sorry, we can get 100,000, and then we can say 2 million divided by the 100,000, which is the number of shares, right? And then we get our, sorry, this calculation, I'll just correct that. This calculation right here is actually giving us the book value per share, right? Which will be 1, 2, 3, 4, 5, which will be 20. And then this book value of share of 20, we multiply it by the market to book ratio, and then we get the market price of the share. Okay. Yeah. So the book value per share is actually just this part. This is actually just the book value per share. And then once we get the answer here, which is 20, we multiply that by our market to book ratio, then that gives us the market price per share. So those are two important formulas to remember. Remember, you can get your price per share by taking your price to earnings ratio multiplied by your EPS, or you can also get the price per share by taking your market to book ratio multiplied by the book value per share. So the answer we get there is 4 Rand, which is option 3. So I say don't mind these options that have been chosen. I'll be showing you the correct calculation. Some of these might be slightly different from what the correct calculation actually is. Next question, number 2, is asking us to calculate the times interest and ratio. It's actually asking us to calculate the times interest and ratio, TIE, right? So like we always say, when you want to calculate any particular ratio, right, your starting point should be to write the formula for that ratio. And then you have to check if you've been given all the information you need to calculate the ratio. And then if any information is missing, you usually have to use another ratio to get the information that's missing for that ratio that you need to calculate. So in this case, we know that the times to interest and ratio is given by our EBIT over our finance cost or our interest expense, right? But you'll notice that we haven't been given our EBIT. We've just been given the interest, which is the finance cost. We've been given sales, we've been given tax, the net profit margin, but we don't have our EBIT. So we somehow have to use this information to calculate our EBIT. Then we can substitute it into this formula divided by the finance cost, and then we can get our times interest and ratio. Okay. So we know from our studies, right, that when we get to the net profit of a company, we take the EBIT, then we subtract interest expense, any interest expenses we have, and then we subtract tax, the tax expense on the earnings before tax, right? So we want to calculate EBIT. So we can simply calculate our EBIT by taking our net profit, adding back the interest expense, and then also adding back the tax. Okay, so we need to just take our net profit, add back our interest expense, add back our tax, and then we'll have our EBIT. Then we can divide that by our interest expense. So the calculation is as follows. Okay, one other important point, when you're writing the exam for FIN2601, I advise you to do ratios last, right? I advise you to do ratios last because ratios tend to take a lot of time and you just get the same marks. Like it could be a 40-mark exam, 35 marks for each section, 70, whatever number of marks. All the questions you answer get the same weighting. You are given the same mark for each question, right? So you'll find that there are easier questions whereby you don't have to go through all these mathematical steps we're going through to get the answer. So I always advise students to attempt ratios last in the exam. Like don't Don't start with ratios, otherwise you'll run out of time and you won't be able to answer simple time value of money questions that are straightforward and you can do quickly. Even bond valuation is sometimes a bit more straightforward. Whereas ratio analysis and calculations to do with ratios, they take a lot of time, and at the end of the day, you're just getting the same marks. Like all the questions tend to be given the same marks. So just be careful with running out of time whilst you are attempting to get everything correct on ratios. Start with other sections, do time value of money, do bond valuation, do risk and return, then come back to ratios, and then maybe share valuation last. Because the share valuation and ratio analysis, those two are the ones that tend to take time. Okay, so let's continue. So we want to get our EBIT, and we've said that our EBIT is equals to the net profit plus the interest expense plus the tax expense, right? So we can calculate our net profit by simply using the net profit margin. And the calculation is simply our sales multiplied by our net profit margin. And then the answer we get is our net profit. In this case, it's 60,000, right? And then our interest expense, we've already been given our interest expense is 10,000. And then lastly, our tax expense. We can calculate our tax expense using the following very important formula. The tax expense is simply given by our tax rate multiplied by our net profit divided by 1 minus the tax rate. So this is an important formula to remember, especially for EBIT calculations. So if we take our tax rate times our net profit divided by 1 minus the tax rate, we get 40,000. And then this 40,000 is our tax expense. We can substitute it back into our formula, whereby we say our net profit plus our interest expense plus our tax expense, and then we get 110,000 as our EBIT. And then once we have that 110,000 as our EBIT, we can now substitute it into our formula, 110,000 divided by 10,000, and then we get 11, right? So the correct answer there is number 1, it's 11, right? Based. So I'm saying ignore the options that were chosen here, but like the students might have been choosing their own options. So we're correcting that and checking if the answers are right. So the answer there is 11, right? Okay. Next question. Next question is question number 3. We continue with ratio analysis. This one doesn't have a lot of information, but it's got something important that tends to come up from time to time in the FIN2601 exam, where you're given a current ratio, then you're asked to calculate a quick ratio, and you've also been given inventory or other values. So there are 3 ratios. I've seen that in this module. There are 3 ratios that tend to be asked together. They tend to be questions which sometimes involve the current ratio, the quick ratio, and the inventory turnover. So sometimes you'll get a question which has these 3 aspects. You might find that in the question you're given a quick ratio, a current ratio, and then maybe you're given a quick ratio, and then you need to find something here like inventory, and then you need to use that inventory to calculate the inventory turnover. Or you might find you are given the inventory turnover, and you're given the current ratio, and then you need to find inventory from the inventory turnover. Then you put that inventory there for the quick ratio calculation, and then you might need to use the current ratio maybe to get the current liabilities, which will also be used for the quick ratio. So these 3 ratios, you'll see there are actually quite a number of questions in this exam prep, whereby you'll be given these 3 ratios, and then you'll be required to do some calculation whereby you have to calculate either the quick ratio, the inventory turnover, or the current ratio by using the information given. So this is already one of those types of questions, but in this question we've just been given we want to find the quick ratio. We've been given the current ratio, and we've also been given inventory. Right. So the starting point is always to write your formula. Remember your ratios, minus inventory over current liabilities. And then you check to see if you've been given this information. We've been given our current liabilities. We've been given our inventory, but we haven't been given our current assets. Do we have any other financial ratio here? Yes, we do, the current ratio. The current ratio is our current assets over our current liabilities. We can substitute in our current ratio. We can substitute in our current liabilities. And then we can easily find our current assets. And then once we find our current assets, we can substitute them there. Then we can subtract inventory divided by current liabilities. And then we'll have the answer. So in this particular case, like we're saying, we need to calculate current assets using the current ratio. 2.5 is equal to our current assets over the current liabilities. To get the current assets, we can cross multiply. We can take 2.5 times the current liabilities of 2,000, giving us 5,000. And then our quick ratio will be the current assets minus inventory divided by current liabilities, which will give us an answer of 2. Okay. Question number 4, again, you see what I was talking about. You're given a current ratio, you're given a quick ratio, you're given an inventory turnover ratio, but you're asked to find cost of goods sold. Which of these 3 ratios has cost of goods sold in its formula? This is the inventory turnover ratio. Inventory turnover is equals to cost of goods sold over inventory. So we can calculate, and then we can cross multiply. If we take our inventory over times inventory turnover times inventory, we can get cost of goods sold. Inventory turnover we do have, but we don't have inventory. How can we get inventory? We have to get inventory from our current ratio and our quick ratio. And then once we have that inventory, we can then multiply that inventory with our inventory turnover, and then that can give us the cost of goods sold. So the idea with FIN2601 is that usually you're asked to find a ratio, or you're asked to find something from a ratio, right? And then you need to use information from other ratios to calculate the inputs that you will need for whatever you want to calculate. So let's see how we would do that. How would we get our inventory, right? How can we get our inventory if we have our current ratio, our quick ratio, and also our current liabilities? Let's see that. How would we go about that? So we've seen that our inventory turnover is cost of goods sold divided by inventory. So we need to use the current ratio and the quick ratio to get the inventory, then substitute it above to get the cost of goods sold. So the first thing we have to do, we have to calculate our current assets using the current ratio. And then we'll take those current assets and our current liabilities to the quick ratio to help us to calculate inventory. So our current ratio is 2.4, which is equals to our current assets over our current liabilities. We can cross multiply to calculate our current assets. We simply take our current ratio, multiply it by our current liabilities, and then we can get our current assets. Next, we can substitute those current assets and the current liabilities into our quick ratio. Then we can solve for our inventory. Quick ratio is equals to the current assets minus inventory over the current liabilities. Cross multiply, 1.5 times our current liabilities is equals to our current assets minus inventory. Group everything to the same side. Negative inventory, if we take it to the other side, it becomes positive. positive 1.5 times 600,000. If we take it to the other side, it becomes negative. So 1.44, 1,440,000 times 1.5 times 600,000, giving us inventory of 540,000. Then once we've got our inventory, we can now multiply our inventory with our inventory turnover to give us the cost of goods sold, right? So you see what I keep emphasizing here, right? In the exam, these types of questions are not the types of questions you should start with. These are the types of questions you should do last. They require a lot of time. Your time will finish in the exam if you start with ratios, and you're only going to get 1 mark, unless maybe they change the weighting and they say ratio calculations carry 2 marks, but that's not the case. Like historically, for FIN2601, ever since the exam was venue-based tool when it became online, each question for ratio analysis only carried 1 mark, the same with time value of money, bond valuation, risk and return. So it's better to start with the easier questions where you can get easy marks quickly rather than spending a lot of time on ratios, and then you might end up failing to finish the exam. Right, the next question, question number 5. Question number 5 says Factor Max is currently selling for 75 Rand per share. If it is selling at a price to earnings ratio of 50, what is the company's most recent earnings per share? Okay, so this is that unique relationship we were talking about before, right? Where we said we can take the price to earnings ratio and we can multiply it by the earnings per share, and then this should give us the price, right? So in this case, if we want to get the earnings per share, we can just take this to the other side, and then we can simply say our price. So this side it's multiplying, so when it goes to the other side, it divides. Our price divided by the price to earnings ratio will give us the earnings per share, right? So we can say 75 divided by 50, and we can get 1.5. And then there's another approach you can use. The other approach is to say the earnings per share is equals to 1 over the price to earnings ratio multiplied by our price, which is 1 over 50 multiplied by our price. And then I think this should be 0.02 multiplied by 75, which should give us 1.57. So those are the 2 approaches you can use. That one is a relatively simple calculation. I used the second approach. Question number 6. So question 6 says, Straw Corp has an operating profit of 1,200 produced from 9,800 sales. If the company has no interest expense and currently pays 35% of its operating profits and taxes and 200 per year, 200 per year in preference dividend, what is the company's net profit margin? Again, when we're dealing with ratios, we start by writing the formula for the net profit margin. The formula for the net profit margin will be our net profits over our sales. Have we been given the sales? Yes, we have. Have we been given the net profit margin? Have we been given? Actually, right, remember, it's not net profit only, it's net profit minus preference dividends. So that's really, really important. Let's not forget that. It's actually net profit minus preference dividends over our sales. So we've been given our sales, but we have not been given our net profit, right? We have preference dividends. So the problem here is our net profit. We somehow have to use this information to calculate our net profit, right? Which information can we use to calculate our net profit? We've been given the operating profit, which is our EBIT. We know that our net profit is equals to our EBIT, right? It's equals to our EBIT minus the interest expense. We know it's equals to our EBIT minus the interest expense minus tax. We've been told there's no interest expense. We have our operating profit. So the problem now is our tax. What is our tax? It pays 35% of its operating profits. So our tax is going to be 35% of the earnings before tax. That's going to be our tax expense. Our tax expense is going to be 35% of our earnings before tax. So we know that if we have our EBIT of 1,200, we can subtract the interest, and then we can get the earnings before tax. So in this case, our earnings before tax is just going to be 1,200. So we can say 35% of 1,200, and then that can give us our tax. And then we can take our EBIT minus 0, minus the tax, and then we can have our net profit. Then we can substitute that net profit into our formula to calculate the net profit margin. So the calculation is on the screen here. Net profit margin is equals to net profit minus preference share dividends over sales. Our net profit is going to be equal to our EBIT minus our interest minus the tax. The tax is simply the earnings before tax multiplied by the tax rate. The reason we multiplied the EBIT by the tax rate here is because our EBIT is equals to our earnings before tax. EBIT is just equals to earnings. EBIT is equals to EBT in this case, because we don't have an interest expense. So we could just take that and multiply it. Otherwise, if we had an interest expense, we were going to say our EBIT minus interest, and then the answer we would get would be the earnings before tax. And then that earnings before tax is what we would multiply by the tax rate. So that's important. Okay. And then once we get that, we can substitute into our formula, net profit minus preference dividends over our sales. So remember, the net profit margin is a percentage. We then change the decimal to a percentage, which is 5.92. Question number 7. Q Corp has earnings before. So remember, we're saying don't worry about these answers, right? On the screen, the correct answers are what I'm showing you. We're sort of like going through what the student had done. So this is actually 5.92, or these options were just picked. So we want to pick the correct one. We want to be checking these answers. Q Corp has earnings before interest and tax amounting to 15,000 Rand, and has a times interest and ratio of 6. Total assets are 100,000. The corporate tax rate is 40%. What is the company's return on assets? Again, our starting point, we write out the ratio for whatever we're trying to find. So you should have a formula list of these ratios, or you should have memorized them, minus preference dividends over total assets. So this is our formula. Then you quickly check, have I been given the things I need here? We don't have any preference dividends. So this has been given. We've been given total assets, but we don't have the net profit. Again, we can calculate the net profit using our EBIT. You know that we can do this plus interest. Sorry, our net profit is actually EBIT minus interest minus tax, okay? We've been given the tax rate. We don't have the interest expense. We don't have tax expense, but we've been given the tax rate. So what do we need to do here? We need to calculate our interest expense, and then we also need to calculate our tax expense. Then we need to subtract those two from the EBIT. That will give us the net profit. Then we can substitute the net profit into the formula for return on assets. So let's see if we can do that. So the first thing we need is the interest expense. Is there any ratio here that has the interest expense? Yes, there is. The times interest and ratio has the interest expense in it. We know that the times interest ratio is equals to our EBIT over our interest expense. So if we cross multiply, our interest expense is equals to our EBIT divided by the times interest end ratio, which will be 15,000 divided by 6, and then that will give us our interest expense. And we calculated that interest expense to be equal to 2,500. And then once we have that interest expense, we can calculate our tax. Remember, we can say our EBIT, which is 15,000, minus our interest. We've calculated our interest to be our interest is 2,500. So this gives us 12,500. So this is the earnings before tax. So our tax expense is going to be our earnings before tax multiplied by the tax rate. So that's going to be 12,500 multiplied by 40%. That will be the tax. And then that tax that we get there, which is 12,500 times 50%, the tax is 5,000. So we're going to say our net profit is equals to our EBIT minus the interest expense, right? Minus tax. This, yeah, minus tax, yes. So it's going to be our EBIT minus interest, minus tax, giving us 7,500. So the calculation here is just the earnings before tax. And then we can take the earnings before tax times the tax rates to get the tax expense. And then we can take our net profit minus the preference share dividends divided by the total assets. Then we can get 7.5%, 0.075. So just remember the ratios, which are percentages, right? Return on assets, net profit margin, return on equity, operating profit margin. See, those are all percentages. Gross profit margin, net profit margin, operating profit margin, return on equity, return on assets. I think those are the 5 percentage ratios we have. And the debt ratio. The debt ratio can also be expressed as a percentage. And there it is for question number 8. So the answer for question number 7 is 7.5%, which is the first option. So the student got it right there. Next, let's look at question number 8. So we've been told Dash Limited reported a debt ratio of 35% and total liabilities of 88,043. If the company has no preference share dividends, the net profit for the year amounts to 26,278. What is the return on assets? So for this question, there's a fast way to do this question and there's a longer way. I'm going to show you both ways, and then I would advise you go for the faster way, right? Because we always want to save time. We can take our net profits, the formula for return on assets first. Always write the formula for what you want to find, minus our preference dividends divided by our total assets. So this is the formula, right? Now we ask ourselves, have we been given the net profit? We have. We've been told there are no preference dividends. We've been given this, but we don't have our total assets. If you've been given the debt ratio and your total liabilities and you want to get your total assets, a fast way of doing the calculation is simply to say 100% divided by 35% multiplied by your total liabilities. In other words, you can say 100% divided by the debt ratio multiplied by the total liabilities. That will give you the total assets. Another approach is to calculate your total assets by saying your total assets are equals to your total equity plus your total liabilities. Actually, we can calculate it. We can calculate total assets just using our debt ratio, right? Remember, our debt ratio is equals to total liabilities over total assets. So we can simply cross multiply whereby our total assets will be equal to our total liabilities over our debt ratio. So this formula is in fact just the same as that formula. So it's essentially the same thing. You'll get the same answer. It's just the same thing. It's only just written in a different way, actually. It's just the same thing. It'll give you the same answer. So if you say 100 divided by 35 times times 88043, you will get the same answer as if you just say 88043 over 0.35. 88043.35, we get 251551. And then if we say 100 divided by 35 times 88043, we get the same answer. So both approaches work. They're actually both very simple. So there isn't one we can say is easier than the other. Right. So once we have our total assets, we can then just simply substitute net profit minus preference share dividends divided by total assets. Remember, return on assets is a percentage. Always remember to change it to a percentage by multiplying by 100. So the answer is 10.45. Question number 9. We won't spend a lot of time on this question. It's one of those questions again. You can actually just practice this one. You can even put the recording on pause and see if you can do it. We've been given, it's one of those questions again. We now know this: current ratio, quick ratio, inventory turnover. These questions, when they come a lot, we've been given the current ratio, we've been given the quick ratio, we have to calculate the inventory turnover. Inventory turnover is cost of goods sold over inventory. We've been given the cost of goods sold, but we don't have inventory. So we need to use these two ratios to help us to calculate inventory. We have the current ratio, current assets over current liabilities. We've been given current liabilities into the current ratio. So we can use these two, cross multiply them to get us the current assets. Then we can take those current assets to the calculation for the quick ratio. The quick ratio is equals to current assets minus inventory over current liabilities. We now have this, we now have that, we have that, so we can solve for inventory. And then after solving for inventory, we can substitute it here and we can get our inventory turnover. So you better try it, put the recording on pause, just give yourself maybe 5 minutes, 4 minutes, 3 minutes, try the calculation, see if you can do it. Start here, calculate your current assets, cross multiply current ratio times current liabilities. Get your current assets, substitute here, along with your current liabilities and your quick ratio, solve for inventory. Get inventory, substitute it here, cost of goods sold divided by inventory. Then you get your inventory turnover. Put the recording on pause, try that. And then when you're done, press continue. Then we can check to see if you got it correct. Okay, so hopefully you were able to do that calculation and hopefully you were able to get the following answer, 2.5, right? So remember this formula, these three ratios always come together. They're like a triplet, so to say. The current ratio, inventory turnover, quick ratio. Current ratio, inventory turnover, quick ratio. Like you can be asked to calculate cost of sales, inventory turnover, inventory, current assets, current liabilities. Usually it's inventory turnover, cost of sales, or inventory. You're asked to calculate one of those and they're given the inventory turnover, current assets, current ratio, current quick ratio, sorry, quick ratio, current ratio, and your inventory turnover. So you need to be familiar with that. So here we calculate our current assets first, substitute those current assets to get our inventory in the quick ratio, then substitute for the inventory turnover. Question number 10. You are considering investing in XYZ Corporation, a steel manufacturer. You would like to determine the proportion of total assets financed by the company's creditors. The company's total assets are 2,500,000 with equity of 1,750,000. What's the debt ratio? This question is a bit easy. Debt ratio is simply our total liabilities of our total assets. We've been given our total assets, but not our total liabilities. But we can use the accounting equation, which says total assets is equals to total equity plus total liabilities. So we can simply say total assets minus total liabilities to give us total equity. So we can take our total assets minus our total equity. Sorry, we actually want to calculate total liabilities. So we can simply say total assets minus total equity to give us our total liability. It's the accounting equation, right? So total assets is 2.5, total equity is 1.750. If we subtract those two, we can get our total liabilities. And then we can take those total liabilities divided by our total assets. These are the types of ratio questions we pray for because it's really straightforward and it doesn't take time. You see, it's like half a page, whereas the other calculations can go like 2 pages or a whole page like this one. This question number 4 is a whole page and a half. You see, some questions can take a lot of space, whilst others, like the one we just did, they don't take too much time. Question number 11 is just a theory question that wasn't communicated nicely, but we can try to make sense of it. No, question 11 was actually communicated really straightforward. But question 12 is the one that wasn't communicated nicely. Okay. Question 11 says company J and company K each recently reported the same earnings per share. Company J stock, however, trades at a higher price. Which of the following statements are correct? So in other words, these two have the same earnings per share. So in other words, shareholders are getting the same profit. Each shareholder in each company is sort of like getting the same earnings per share, right? The company is able to generate the same profit per share, right? They each generate the same profit per share. However, we've got two companies, J and K. We've been told that we've been told that company, however, even though they both have the same earnings per share, the price for J is more than the price for K. So the price for J is more than the price for K. So which of the following statements are correct? Remember, our price to earnings ratio is simply given by the market price divided by the earnings per share. So if one of these shares has a higher price compared to the other, it means that investors are prepared to pay a lot of money for that particular share. In other words, they find that share attractive. They want to buy that share. They think that that's a good company to invest in. And usually, companies that trade at very high price to earnings ratios are usually really good companies to invest in. It means that investors believe that those companies have a lot of potential, so they are prepared to pay much higher compared to the earnings or the profits that the company can give them. So the conclusion we can get is if stock J has a higher price than K, even though both have the same earnings per share, it means that company J must have a higher price to earnings ratio. Investors are prepared to pay a much higher price for the earnings because they believe company J has potential compared to company K. So the correct answer there is option 1. Option 2 is wrong. The market to book ratio has got nothing to do with the earnings per share. Option 3 is wrong. Company J is not necessarily riskier. We can only actually see here that investors think that company J has more growth potential, hence they are prepared to pay a higher price for it. So this is actually wrong. This should actually say company K has fewer growth opportunities. Company J actually has more growth opportunities, hence investors are prepared to pay much more for that particular share. Okay, we're nearly done. Question 12, question 13, 14, 15, 16. We're nearly there. Question 12 is theory. A firm is considering actions which will raise its debt ratio. It is anticipated that these actions will have no effect on sales, no effect on operating income, and no effect on the firm's total assets. If the firm does not increase its debt ratio, which of the following will occur? Okay, so this option has been chosen. We're not saying this is the correct option. We now want to discuss and decide which of these is the correct option. Okay. So this particular company, right, is thinking about raising its debt ratio. So when it raises its debt ratio, it's not going to affect its sales, it's not going to affect its operating income, and it's not going to affect its total assets. Okay. Right. So if the firm does not increase its debt ratio, let's say the firm doesn't increase its debt ratio. Let's say the firm keeps its debt ratio as it currently is, right? Let's say it doesn't increase its debt ratio. Which of the following will occur? Option 1 says returns on assets will increase, right? Option 2 says the times interest earned will increase. Option 3 says the profit margin will decrease. And option 4 says total asset turnover will increase. Now, we know that the times interest earned ratio is equal to EBIT divided by interest. We've been told that with no debt issued and with debt issued, right, the EBIT is going to be the same. It's not going to change. That's what we've been told here. The issuing of debt will have no effect on the operating income. So the operating income before will be the same as the operating income after, whether with no debt or with debt. However, if we do increase the debt ratio, right, we are going to have a higher interest expense. We're going to have a higher interest expense. We have to pay interest on that debt, right? We raise our debt ratio, right? We are going to have a higher interest expense. So I'll just repeat that just for clarity's sake. If the company issues debt, there's going to be a higher interest expense, right? And because there's a higher interest expense, it means that our EBIT divided by the interest expense to calculate the times interest earned ratio will be lower. Whereas if no extra debt is issued, the interest expense will be lower. And then that means the times interest earned ratio will be higher, right? So I would pick this option. However, this question was not worded correct. It wasn't worded nicely, like it wasn't communicated nicely, right? I'm not sure if the question was actually meant to say, I'm not sure if maybe the question was actually meant to say, if the firm does increase its debt ratio, which of the following will occur? I'm not sure if this not is a mistake. So this question, because the explanation now, if you're talking about something happening, if it does not increase its debt ratio, and then you are now saying the return on assets will increase the times interest, because it would rather be proper English to say that the return on assets will remain the same, the times interest will remain the same, because we are starting with a certain debt ratio, and then we are thinking about increasing. So if we decide not to increase, the correct options here should be remain the same, not increase or decrease, because we're not changing anything. If you decide not to increase the debt ratio, you're not changing anything. So you would assume that the correct answer should be that one of these things remains the same, right? So I think maybe there might have been an error here, whereby the question was supposed to say, if the firm does increase its debt ratio, which of the following is going to occur? Let's say the question said, if you increase your debt ratio and your total assets are the same, your EBIT is the same, you're going to have a higher interest expense. So that would actually mean that your return on assets should decrease. Obviously, your times interest end ratio will increase because you'll have no, obviously your times interest ratio will decrease because you'll have a higher interest expense, whereas the operating income is still the same. So I'm saying, let's say the question said if the firm does increase its debt ratio, which will occur. So definitely the times interest end ratio will decrease. Return on assets will definitely probably have to decrease due to the higher interest expense. The profit margin, yeah, this is the most likely question to answer here. The profit margin would decrease because you would now have a high expense. So if the question had said if the firm does increase its debt ratio, which of the following will occur, I would pick this one. Total assets turnover will not change, right? Because it's sales over total assets, and we've been told that our sales are going to remain the same and the total assets remain the same. So this one wouldn't change. This one would decrease due to the higher interest expense being divided into the EBIT, and then this one would decrease. So let's say the question had said, if the firm does increase its debt ratio, which would occur, I would pick option 3, and that would make sense. However, here we're asked if it does not increase its debt ratio, which of the following would occur. So we've seen that the times interest end ratio is actually higher if the debt ratio is not increased, and it's lower if the debt ratio is increased, because we're simply taking operating income divided by interest expense. So if debt is issued, there'll be a higher interest expense. But like I'm saying, the question wasn't worded very nicely there. The next question, question 13, we're not going to spend time on this. We've looked at these questions a lot. Okay, no, this one wants us to calculate the average age of inventory. It's a bit different. But again, it's that question where we're given a quick ratio, we're given a current ratio, and we want to calculate something associated with the inventory turnover. Remember, the average age of inventory is simply equal to 365 divided by the inventory turnover. So we need to calculate our inventory turnover, then say 365 divided by that inventory turnover, and that will give us the average age of inventory. So we know that the inventory turnover is cost of goods sold divided by inventory. We've been given cost of goods sold, but we haven't been given inventory. So we then have to use these two ratios. Once again, I think this is like the 4th time we've come across these 3 ratios. We need to use these 2 ratios once again to help us to calculate inventory. Then we can substitute the inventory here, cost of goods sold divided by the inventory to get the inventory turnover. Then we can say 365 divided by the inventory turnover to give us the average age of inventory. Okay, so this is something you should now be able to do. You can put the recording on pause, and then you can try the question. And then we can check to see if you got the right answer. I mean, you should now be comfortable with this. This is now, obviously, usually you'll start with the current ratio, and you'll be given like your total current assets. Then you need to use that relationship to get your total current liabilities, right? To get you've been given your current assets, you need to use that to get your current liabilities, right? The relationship. So you've been given the current ratio. So you need to take your current assets and your current ratio, then you get your current liabilities, right? And then once you get your current liabilities, you need to take your quick ratio, your current liabilities and your current assets, and then you need to calculate your inventory. Then you need to take that inventory and you need to substitute it. So put the recording on pause, try that quickly. And then when you're done, press continue, then we can check if you got that right. Okay, so hopefully you got that right. This type of question, right? It should be a type of question that you are really comfortable with. Like you should even write formulas out. I've now tried to simplify it for you a bit. For question 13, we just cross multiply, divide your current assets divided by 2 to give us our current liabilities using the quick ratio. Sorry, this should actually be okay, using the current ratio, sorry. Then we get 2000. And then now I want to give you a shortcut to help you in the exam, right? Usually you'll be asked to use the current ratio to calculate current assets or current liabilities. If you've been given current assets and you want to get current liabilities, you simply take your current assets divided by the current ratio to give you your current liabilities. If you've been given current liabilities and your current ratio and you want your current assets, you can simply multiply your current ratio times your current liabilities to give you your current assets, right? And then once you've got your current assets or your current liabilities, right, you can use this formula right here, this formula to help you to calculate inventory. If you want to calculate your inventory, simply take your current assets minus your quick ratio multiplied by your current liabilities. Simply take your current assets minus your quick ratio multiplied. So this is an important formula I'm now giving you that you can use to help you in the exam when it comes to calculating inventory, which you can then use to help you to calculate the inventory turnover. So we simply substitute our current assets minus the quick ratio times current liabilities. We get 1,600. We say 25,000 divided by 1,600, our sales, cost of sales over our inventory to give us the inventory turnover. And then we take that inventory turnover, we take 365 divided by that inventory turnover to give us the average age of inventory, which I hope you got there as 23.36 days, which is option 4. And then question 14. Now, when you get questions like question 14, which says Georgetown Motor Cars had a profit margin of 428,571 and sales to the amount of 10 million. The company had a return on equity of 15% and an equity multiplier of 1.67. What is the company's total asset turnover? When you get this type of question with the equity multiplier and return on equities, immediately you should think about the DuPont relationship, which says the return on equity is equal to the net profit margin multiplied by the total assets turnover multiplied by the equity multiplier or the financial leverage multiplier. So we have been given our return on equity. We've been given our net profit margin. Okay, we haven't been given our net profit margin, but our net profit margin is simply our net profit minus preference share dividends over our sales, right? We want to calculate the total assets turnover, and we've been given the equity multiplier. Okay, so we have everything we need here, and we want to calculate the total assets turnover. So we can easily calculate our total assets turnover by taking our return on equity, right, divided by the net profit margin multiplied by the equity multiplier. Right. So that then means we can take, we can calculate our net profit margin, which is 0.04286 times the total assets turnover times the equity multiplier. And then we can simply say our return on equity divided by the product of the net profit margin and the equity multiplier. So return on equity times net profit margin times equity multiplier. Then we get 2.09. The slight difference there might be due to rounding off, but that's the approach. So that's an important relationship for calculating return on equity. And then also remember that the DuPont analysis says that return on assets is equals to net profit margin times total assets turnover. So these two are really important relationships. ROA is net profit margin times total asset turnover. ROE is net profit margin times total assets turnover times equity multiplier, also known as the financial leverage multiplier. So this also means that return on equity is equals to return on assets times the equity multiplier or the financial leverage multiplier. So these are three really important relationships, and it's known as the DuPont analysis to help us to get return on equity and return on assets. Okay, so we're nearly done there. 2 more questions. Question 15 says, Peterson Limited had a profit after tax of 79950 and preference share dividends of 15,000. If the company generated 8605 in ordinary shares issued, what is its earnings per share? Again, we always start with the formula for whatever we want to calculate. EPS, now this one is a really, really simple question. We know that EPS is equals to our net profit, so our profit after tax minus preference dividends divided by the number of ordinary shares outstanding. So this one is really simple. It's just 79950 minus 15,000 divided by 8605. So these are the type of ratio questions we hope to get. I mean, you see, I did that in less than a minute. It's a really straightforward calculation and you can get your marks very straightforward there. And then the last question with regards to ratio analysis for the purposes of our exam prep. We've been told that a company has an average collection period of 60 days and accounts receivable of 300,000. What is the company's annual sales based on 365 days per year? So we know that our average collection period is equals to our accounts receivables over our annual credit sales times 365. The reason I've put the credits in brackets is that sometimes they just say annual sales, where sometimes they'll tell you that the sales are credit sales. Ideally, we should use credit sales here. We should use credit sales for this formula. But if credit sales are not given, then we can just use the sales that they give us. And remember, there are two formulas with regards to the average collection period. We can use this formula where we say accounts receivables over annual credit sales times 365, or we can also say accounts receivables divided by the average credit sales per day. So we would calculate the average credit sales per day by taking our annual credit sales divided by 365. Otherwise, for us, we are going to use this formula right here so that we can calculate our annual credit sales. So here we can do a bit of cross multiplication, and then we can say our annual credit sales are equal to our accounts receivables over our average collection period times 365. So it's just cross multiplication. So we can then say our accounts receivables of 300,000 divided by 60 times 365. So this can give us our annual credit sales, right? So the last two questions were a bit simple there. So 300,000 divided by 60 times 365, we get 18250, 1,825,000. So that is our annual sales. Okay, so that brings us to an end of the exam prep on ratio analysis. Please note that these are just my suggestions on these calculations. Like, I'm just guiding you and explaining how you should approach these questions for the exam and so forth. I'm not saying these are the solutions that the lecturer is going to give you, but I'm sure they're the same because I've also explained to you what I'm doing. So it's important to understand why we got an answer. So if you do your calculations and you're getting something different, at least I've provided an argument to you and I've explained how I've done my answers and why I've done them that way. So that's really important, right? Please continue to go through the exam prep classes. You can continue with the other classes. I'm going to also be doing on-time value of money, bond valuation, risk and return. So we're going to cover everything so that you're prepared for the exam. And then also please make sure that for the exam year, you have a formula list of all the important ratios, right? Remember, we have 5 types of ratios: liquidity, activity, debt, profitability, market ratios. Make sure you have all your formulas nearby. And remember, I would advise you to try the longer questions to do with ratios. At the end, when you've already done time value of money, bond valuation, risk and return, those are always easier. Then you can come to financial ratios and maybe end with share valuation. Financial ratios tend to take time, but there are some questions which are easier, as you saw. So you have to be wise and attempt the easier questions first in the exam, rather than your time finishing and you're just doing a few difficult questions and you run out of time. So thank you very much for listening. I hope the exam prep has been helpful and you've learned a lot. Any questions or queries with anything covered, please feel free to let me know. Please be sure to subscribe. You can like the video. If you subscribe, it will always be easier to get notifications if any new videos come up to help you with your studies. So thank you very much for listening and all the best. Thanks once again.